I'm Motley Fool Canada senior analyst Nick Seipel, and this is the 5 Minute Major, here to make you a smarter investor in about 5 minutes. Today, we're discussing Shopify and whether the recent 30% crash on AI driven fears is a buying opportunity or a warning sign for the future. My guest today is Motley Fool Canada Chief Investment Officer Ian Butler. Ian, thanks for joining me once again.
Great to be here as always, Nick, and excited as always to talk Shopify, one of Canada's biggest companies.
Yeah, Shopify shares have been hammered along with basically everything else in software world. Shopify itself down roughly 30% so far here in 2026. As I said, seems to be linked to a broader panic in software stocks over fears that AI will disrupt their business models, the whole software world. A lot of question marks there. Is Shopify's thesis broken by some of these AI headlines, or do you think this is more market panic?
Yeah, I will just state right up front, I am definitely in the market panic camp, and then just a couple points to sort of flush that out. AI, I mean, indeed, it is having a dramatic effect in recent weeks, especially on all software stocks, enterprise software stocks, with the fear that AI is going to make them obsolete, which I question broadly. But Shopify isn't even a coding tool, really, that AI will or can replace. It's literally the infrastructure of commerce, historically online and more so in the physical world as well. So, if anything, I'm of the mind that AI is a tailwind for Shopify. They've got new tools in their arsenal, a Shopify Sidekick, Shopify Magic, which help merchants work faster and makes the platform that much stickier. So they are leveraging AI to benefit its customer base, and that can only improve their eventual outcome. So I'm of the mind that the recent sell-off is entirely unjustified based on company fundamentals anyway, not connected at all. Nothing about this business suggests anything's broken. Quite the opposite. I don't know that Shopify has ever been better, and this is a company that we've been following really since it IPO'd back in 2016-ish. So stock's down 30%, but the business is just continually growing like crazy, north of 20%. Gross merchandise volume and revenue growing in the range of 25 to 30%. So it got expensive. It got expensive last fall. It was sort of trading around 22 times enterprise value to revenue, trailing revenue. And we've seen multiples contract all around it in the technology sphere, and it's just kind of been thrown out with the bathwater, really. It's been pulled down by that gravity that's impacting a lot of its peers. And I'll say it was expensive in the fall, 22 times. Nothing like it was expensive back in 2021 when it traded north of 70 times revenue and experienced a material correction after that, as well as the multiple contracted. But the company has grown significantly since. It reached all-time highs again, and that multiple was significantly lower because of that company growth. So 30% drop has burnt off a lot of froth. I can't say that it won't go lower, but from a fundamental perspective, this is an extremely strong company that is growing better than most.
Yeah, it's an important distinction. AI is a tool for Shopify more so than a threat. I'll just point out anecdotally, if you go to Shopify founder Toby Lutke's X account, pretty much any day, he's talking about the unlocks he's getting from using Claude Code and some of these tools to make him a much more efficient and effective coder to start to bring more features to Shopify. So, as you say, we've seen this type of volatility before in Shopify. We've seen multiples contract significantly, the stock price come down in the short term, but over the long pull, investors in this stock have been rewarded. If you're looking forward over the next 3 to 5 years, which is where we try to look as investors, what are the catalysts that you think will be the important drivers for Shopify's business and its stock?
For sure. And this is the Shopify reports next week, February 11th. And we'll get some evidence of these drivers, and they are namely enterprise and offline growth. I mentioned their growing physical presence, so that is not just an e-commerce situation anymore. So historically, they've been known for their online stores. Biggest growth now is coming from these big enterprise brands and point of sale terminals within physical stores. And so that's opening up a whole new world for this company and why they've been able to maintain the growth that they have. And they've sort of come through a heavy spending cycle, and this is something, again, we've followed this company for a decade, and we knew we would get here at some point. But this has become a free cash flow machine that no longer is money flying out the door without noticeable immediate returns. They are every new dollar of revenue flows more efficiently to the bottom line, and I think we're going to see profits continue to grow probably at a faster rate of sales given the operating leverage that's within this business. And finally, they've really been targeting international markets. For the most part, this has been a North American story and especially a U.S. story. They've only just scratched the surface of the rest of the world. So there's plenty more to the Shopify story than we've already experienced, and we're pretty keen to watch it continue to play out.
Yeah, very rare you see this dominant Canadian software business see this type of drawdown this rapidly. And for investors who are in it for the long term, this could be a buying opportunity. Thanks, everyone, for joining us for this edition of the 5 Minute Major. If you want more stock ideas from us, click on the icon in the upper right of your screen. Hope you enjoyed this video and hope to see you next time. Until then, Fool on.